We've had a massive sell-off in a lot of the tech-related stocks this year in 2026, but I still believe a lot of the stocks, especially the cybersecurity stocks, they're still somewhat expensive. I believe there's two amazing gems in the market that I'm going to talk about. The first one is more of a mega cap quality stock. The second one is more of a growth company with massive upside that I own in my portfolio. I'm going to talk about them and tell you why I like those stocks, and I really hope you enjoy it as always. The first one is Microsoft. Microsoft is down 22% over the last 6 months. I think the sentiment is really, really bad. I used to be a Microsoft hater. I used to say the stock was a bubble. It was just too overvalued. But right now, the risk to reward setup is looking very, very interesting. And I'm not the only one that's saying that. In fact, the insiders of the company kind of agree with what I'm saying. And this is an amazing quote from Peter Lynch. And he says, insiders might sell their shares for any number of reasons, but they only buy them for only one reason. And they think that the price will pretty much go up. And this is what the insiders are doing at Microsoft. You have a director that has purchased $2 million worth of shares. And this is the largest insider buy in 11 years for Microsoft. So what is this telling you? It's telling you that some of the insiders, they believe the stock's undervalued, and he purchased $2 million on the open market from his own money. Also, he gets a lot of stock-based compensation and a lot of incentives, but he's buying $2 million from his own money. To me, that tells me a lot, and that tells me that the insiders believe the stock is undervalued. Now, if you look at the performance of Microsoft, it's been frustrating to many because Google started to recover, Meta started to recover, even Amazon started to recover, but Microsoft keeps on going down. And I don't really know why this is happening, but I believe this is due to the very large correlation with IGV. IGV is here in the yellow, and this is Microsoft in the white on the chart, and you can see the very close correlation with IGV, which is mainly the software-related ETFs, and the software-related ETF keeps on selling off. Every time Anthropic comes up with a new product, they just sell off 5 or 10%. It's been crazy, and Microsoft has been correlating to that with a correlation to IGV of about 98%. This is a high correlation. So Microsoft will likely bottom whenever the software stocks bottom, even though Microsoft is not just a software company. It has the cloud business, which is not going to be disrupted by AI. And it has so many amazing businesses, again, like Azure. They have Microsoft 365, which some people believe could potentially get disrupted. But so far, so good. It's up 17% year on year. Gaming is not going to be disrupted, I think. LinkedIn is still going to be here. Windows and devices will still be here. Search has been growing 15%, and I think will still be here. And also, they have the OpenAI stake and many different stakes in a lot of companies. Now, looking at Microsoft Azure, it has been rapidly taking share from Amazon. Now they have a 21% global share for the cloud market. Amazon has 28%, and the expectations is that Microsoft Azure will overtake Amazon as the largest cloud business by 2029, which is really amazing. Now, looking at the backlog of Microsoft, they have a $631 billion, you could say, backlog for their Azure business or the cloud business in general. And there were some concerns that a decent chunk of it is due to OpenAI. But I talked about this many times, and the other side, which is 45% of the upcoming backlog, is not tied to OpenAI and is growing like 25% plus year on year. And over time, they're going to be transitioning away from OpenAI. They don't really need OpenAI. Yet I see a lot of comments under my X post of people claiming that Microsoft has no moat because OpenAI is losing market share to Gemini. But this is not, Microsoft is not OpenAI. Microsoft has so many amazing businesses, and a lot of them are not actually tied to the success of OpenAI, and especially the cloud business. It was a success before OpenAI. It's going to be a success after OpenAI. Now, if I look at what's priced in the valuation, it's trading at 22 times forward earnings, as low as it was at its 2022 bottom of about 22 times earnings. That doesn't happen very often. It was trading at 35 times earnings not long ago, and now you could buy Microsoft for 22 times earnings. So yes, Microsoft is not doing too well in AI. It's kind of falling behind in certain areas. Yes, ChatGPT is losing market share from Gemini, but how much are we paying for Microsoft? We're paying much less than we could have purchased the stock 4 or 5 months ago, almost 40% less than what we could have purchased it around 35 times, now trading at 22 times earnings. And it's getting so ridiculous that Microsoft is about to become cheaper than Meta. Now, Meta, you could say, is still somewhat of a cyclical business because it's due to advertising. It has a high advertising exposure. Microsoft is mostly recurring revenue within the cloud, within Microsoft 365 and Windows and a lot of the different businesses that they have. So it's much more resilient and it should deserve a much higher multiple than Meta. Yet right now, Microsoft is trading at 22 times and Meta is trading at 21 times earnings. It really tells you how ridiculous this market is and what kind of an opportunity Microsoft is delivering at today's price. Now, in terms of the AI disruption, I believe the best way of doing it is to ask AI itself how likely is Microsoft to be disrupted. And I asked AI and it gave me a score of 3 out of 10 and it gave me a bear case where Microsoft could re-rate to 20 times earnings. Yet Microsoft right now is trading at 22 times, which again aligns with my vision that a lot of the bad that a lot of people are talking about has mostly made itself in the stock price. And stocks tend to bottom on bad news, they don't bottom on good news. They bottom when no one is expecting them to. Now, for my valuation model on Microsoft, I put in the current earnings per share for fiscal year 2026, and I put it 5 years out at 15% CAGR in earnings per share growth. I think this is fair. You have the expectations of 22%, 12%, 18%. I think they can grow 15, 16, 17, even 18% for a while, but I'm putting in 15%. I think it's fair. The trailing P is 24 times. I put it at 25 times earnings. I get a price of $841 per share, or 16% on the upside over the next 5 years, or about a 17% annual return. This is an amazing return to own a mega cap quality company like Microsoft, and that really doesn't happen very often. And you have to remember, Microsoft used to trade at 30 and 35 times earnings. If that ever happens again, the upside from today's price is almost 158% in 5 years, or a 21% annual return on an amazing company like Microsoft. So I believe Microsoft, alongside Amazon, you could say, are two of the most undervalued Big 7 stocks. And that's why I've been buying the dip on Microsoft after waiting for so long to own it. I'm finally getting to own Microsoft and I started to buy the dips. And by the way, I use Fiscal.AI to come up with my charts. If you want to try it out, they give you 2 weeks of free access if you want to use my link in the description. Now, the second stock, which is more of a growth company, is SoFi. SoFi is down 30% year to date. It's been a crazy move on the stock. Although the company has done really well, they have expanded their total members to 13 million members. It has grown at a 54% CAGR over the year, and they keep adding more and more members to the SoFi ecosystem and the network in general. The company is re-accelerating in revenue growth from 26% to 38%. Same thing with EBITDA margin. And this is their second full year of GAAP net income profitable. So the company is killing it, but the stock is going down. It has recently been going down due to the news around Blue Owl Capital, which has permanently halted redemption for a $1.7 billion private credit fund. And if you don't know, SoFi and Blue Owl Capital, they have a $5 billion partnership where SoFi is originating a lot of those personal loans and Blue Owl Capital is the one that's funding them. It's the one that's holding them on the balance sheet. Now, there's not much credit risk here for SoFi because SoFi is not holding those loans on the balance sheet. Blue Owl is holding them, but SoFi is originating those loans for Blue Owl Capital. So if, let's say, there were halting redemptions or there was some kind of a credit risk, SoFi is not holding those loans on the balance sheet, yet the stock is going down with Blue Owl Capital, and it's just a sympathy play where it just go down together. And I think this is a massive mistake because SoFi has been transitioning away from holding the loans on the balance sheet. Now 43% of their business is fee-based, where they don't hold the loans, but they collect an originating fee for being pretty much the middleman, kind of like a real estate agent. The real estate agent doesn't hold the house in his name, he's the middleman. And this is what SoFi is trying to do in the loan business, and that's helping, reduce the risk with this investment, and it has been reduced over time. And I think the risk is overblown. But in terms of the Blue Owl situation, it got sorted out. They found 4 buyers for the $1.4 billion portfolio. And again, I have to remind you that Blue Owl has $300 billion of assets under management. So the $1.4 billion is a tiny percentage of their overall AUM, but the market freaked out about it and it took the stock down around 10% recently. And I think this is a massive, massive mistake. Now, if you look at the guidance of SoFi, they expect the company to compound annual adjusted revenue growth of at least 30% between 2025 to 2028. They also expect earnings per share growth of 38% to 42% between 2025 and 2028. I don't know any company that's guiding 40% earnings per share growth for the next 3, 4, 5 years. And SoFi can achieve it, not just from the revenue growth, but also from the expansion in net income margin, which is like a twin engine for growth. And if you look at how much you're paying for SoFi today, you're paying about 31 times earnings, the same multiple of where the stock bottomed at back in March or April pullback of the tariff drop in 2025. So I think there's a massive disconnect between the fundamentals, the growth, and the stock in general. I think the market is punishing the stock more than it should. I think the stock is undervalued. I like the CEO. I like the management team. I like the guidance. You're buying it less than a 1 PEG ratio. And I like the quality of the business. I like that they've been transitioning away to fee-based revenues, and that's going to reduce the risk of defaults over time. So if they do face defaults from some members, then it's not going to affect them as much because they're just collecting origination fees instead of just holding the loans on the balance sheet. So I like SoFi very much. I also like Microsoft very much. I own both of them and I've been buying the dip on them. And that's my opinion on those stocks. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.